What's going on, guys? Welcome back to another video here. So I have a very interesting video prepared for you guys this afternoon. We're gonna go over a very blatant aspect, or a very blatant example of these large banking institutions attempting to manipulate a very specific market. Now, this is going to have to do with real estate, some of these new loans that have been coming out in the current state of the housing market. So these are things that you guys need to know going into these next couple of weeks. So again, guys, before we get into all of that information, if you do enjoy the information and analysis that I provide for you guys in these videos here, make sure you guys go down and hit that like button. It costs you nothing to do it, but it helps us out a whole lot in getting this information out to as many people who do want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So the first thing that we have to go over here is kind of a little bit of an economic backdrop so everybody fully understands exactly some of the things that have transpired and exactly why. So when we pull up the chart of the SPY here on the daily time frame, you can see that in the time period from November all the way up into the beginning of January was when the market had its peak. This was also the time that the Fed announced that they were going to be raising interest rates and engaging in QT, quantitative tightening. Then what happens after? Well, you see this 1348 cross down here, and you end up seeing the market making lower lows and lower highs throughout basically the entirety of 2022. You see a couple of these cross ups here, a couple of these cross down, but in general, you're seeing the market trending down. We've gone over this a lot in the past, but when you raise rates, it decreases the present values of a lot of these stocks, especially basically high growth stocks, due to these discounted cash flow models that are being used to value a lot of these equities out in the market. So the market's coming down here. We've been able to predict this a lot, and a lot of people have been making a lot of money based on this downturn, but what you have to think about is what happens next, and that's going to have to do with the real estate market. Now, again, before we get into all of that, guys, I do want to shout out a couple of members from our community over here. Mike over here with a 13% P&L day yesterday, Tim with 10% gains over here. Our members are absolutely crushing it with Pythagoras, Invictus, our predictive algorithms that are able to kind of show you guys where the market is going to head before it even happens. And honestly, our members are absolutely crushing it. The results of these people here are really speaking for themselves. So again, guys, if you are interested in really taking control of your portfolios, make sure you check out that link down below. But this is the first thing that we need to think about right here. Citi expands the program to help diverse communities reach transformational home ownership milestone. Here's who qualifies. So what they're essentially doing here, Citi News comes as Bank of America recently announced it plans to offer new zero down payment, zero closing cost mortgage products to help members of the predominantly minority communities buy homes. Here's essentially what they're doing here as we come back higher. Citi is expanding a program to encourage home ownership in diverse communities as part of a new set of initiatives to broaden access to its lending products. The program, called Home Run, seeks to help eliminate the key barriers to home ownership, particularly with regard to cost and affordability. That language there is so important because when you think about the Fed raising interest rates and the effect that that has on mortgage rates in the housing market, well, it makes homes less affordable. Now, that's a natural thing that happens in the market. Home prices have skyrocketed over the last couple of months, essentially even the last year and a half since the pandemic. Now, they do have to come back down to an equilibrium price, and we can go over a little bit more of the housing market in a later video. But what they're essentially doing here is that as these home prices start to come down, it makes it more expensive to qualify for these homes because the interest rates are higher. Now, what these programs are enabling people to do is that if you cannot necessarily qualify for these loans through a traditional mortgage, well, these new programs are going to allow you to purchase that home. What that does is it increases the demand for those price points of those homes, propping up the housing market even further. Now, when we take a look at what Bank of America is doing over here, Bank of America is launching a zero down payment, zero closing cost mortgage product to help members of predominantly minority communities buy their first homes. The program, called the Community Affordable Loan Solution, will be available in certain cities, including Black and or Hispanic Latino neighborhoods. Now, this initiative might be awesome for essentially helping maybe some people who do not have a lot of income buy their first home. But at the end of the day, what we really need to think about here is when has a banking institution or a government really came in and said that they were going to help out the lower class individuals or lower income individuals in lower income areas, and it's actually worked. a really, really good example of this right here. And again, we can take a look at this right here. Overdraft fees did not exist until the 1990s. Now, banks made $8 billion a year in overdraft fees. The CEO of one lender even named his yacht Overdraft. So that's one example there. But another example of what happens when these types of loans start to come out, a perfect example is student loans. When you take a look at essentially the timeline of when a lot of these student loans were coming out, what ended up happening to tuition costs? Well, we can see here, 1965, the first Higher Education Act created guaranteed student loans, a public-private partnership with the federal government subsidizing capital from banks to provide loans to low and middle income students. Sounds very familiar to what happened with the housing market. It's kind of happening now, and what was happening back in 2008. You can read kind of these new loans that are coming out as sort of like those ninja loans. They're not identical, the no income, no job loans that were basically being handed out like candy before the 2008 global financial crisis. But what happens here is that the government comes out, especially with tuition here, and says, we are going to basically guarantee these loans. Well, what then happens is that, well, all of the different educational institutions then come out and say, well, if the government's just going to pay, we'll just increase our prices. So what happened then over the next basically 20, 30 years, 40, 50 years even after this actually came out? Well, you can see that the average undergrad tuition and fees for public institutions in 1980 was about $1,856. In 2020, $9,403. And as you can see here, according to the Bureau of Labor Statistics, the highest year-over-year change in college tuition and fees was recorded in June 1982 at 14.2%. Over that same period, overall inflation was up 6.6%. So it's not the result of inflation that these prices are getting significantly increased. So here's what we need to understand about this housing market situation right now. When the Fed is raising interest rates across the board, what you end up seeing is home prices come down. Mortgages get more expensive to essentially enter into just because of the fact that there's going to be higher interest rates. If you do not qualify for those types of loans, then you have to go for a lower price point home. Now, if these large banking institutions are going to come in and say, hey, I understand that the Fed is doing this to basically stifle the inflationary pressures on our overall economy, we are going to see mortgage rates increase, which we have seen. We're going to see supply increase as well. Well, we're going to come in here and say, hey, well, we're going to offer these products to prop up demand in this market to essentially almost nerf is the best term that I would describe this as, almost nerf the ability for home prices to collapse significantly. Now, the thing is that if these loans end up turning out like those ninja loans, where people can no longer afford those payments and there starts to be a massive wave of foreclosures, well, then that just adds fuel to the fire of the home price decrease that is already going to happen. So guys, that is essentially going to wrap up this video here for you guys this afternoon. If you guys did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And again, if you do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great weekend. I'll see you guys in the next one. Peace.